It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
People don't realise that the credit legislation that we have in Australia gives people the right to ask for their contract to be varied if their circumstances have changed. And it's worded so that the customer can ask their lender for whatever variation they need on their contract so that they can meet their obligations. And the lender has to consider that request. If they don't agree with it, they have to say why. Because this is a right that people have, if they can't reach agreement with their lender, they can make a complaint with the Australian Financial Complaints Authority. So people have more rights and more options than they often know about when they call us.
And that is Claire from Melbourne, and we'll be getting back to that conversation in just a moment as we welcome you back into another real estate podcast. Yes, every morning you can stream and listen to us anywhere. And we've had lots of your emails telling us that you're listening in the car on the way to work, which is how you take in your morning dose of real estate. Because from Hobart to Cairns, we are here 7 days a week, and we are talking to all of the people who matter to keep you updated on the Australian property market. It is a Tuesday today. Nice to get Monday out of the way. We've almost got the month out of the way as well. February the 25th. And recently we were talking about this PropTrack piece over 1.1 million Victorian households. They're struggling with mortgage or rental stress, with some postcodes nearly 10,000 strong. In other words, 10,000 families are fighting to keep a roof over their heads. And according to this recent data, more than half of the state's mortgage holders and 77% of renters are facing financial strain. Now, last week, the Reserve Bank's interest rate decision, that does help a little, but there is still a major struggle for people to still hold on and maintain their homes. So let's welcome into the Real Estate Breakfast this morning, Claire Tacon from the Consumer Action Law Centre's Financial Counselling Practice. And a very good morning to you, Claire. Welcome to the Real Estate Breakfast. And as I say, you know, the RBA, whilst they did lower the rates last week, people are still boxed into a corner with the stress load.
That's very true, yes. I mean, I think the most important thing about the rate cut is the hope that it brings to people, that, you know, maybe there's light at the end of the tunnel, but it's going to take a lot more than one rate cut to really meaningfully assist the people that we speak to.
Yeah, and just on that note, you know, with the people that you are interacting, because you're at the coalface there, over the past year, I think you guys have reported that 1 in 4 calls to your helpline has been about mortgage arrears. How significant is that compared to previous years?
Yeah, so our calls have gone up 50% since interest rates started to rise. So first interest rate rise was in 2022. And in that time, our calls have gone up 50%. And there has been a shift, as you said. The top reason that people are calling us now, the most common conversation that we're having with clients is about mortgage arrears. And in the 10 years that I've been in the financial counselling sector, that's never been the case before. It used to be an unusual conversation, or it definitely wasn't the conversation that we were having every day with people. And, you know, they were always the hardest conversations because, you're talking about someone's home. Yeah, so it's been a big shift really in the work that we do on the National Debt Helpline.
Yeah, I think that you guys mentioned that before 2022, the top reason for the calls were credit card debt and energy bills. So that kind of signals exactly how much of a change there's been. And with this PropTrack piece, new analysis of over 52,000 Australian households, they are facing severe financial strain. households spending more than they earn. They are cutting back on these essentials. They're dipping into their savings or taking on more debt to service it. And as these cash flow pressures mount, many are forced to forego dental care, also quality food and non-essential spending. I just wonder how much of a health risk we're actually sort of talking about here with the people that you're talking to, because it's got that flow-on effect. How can it not?
No, as you say, how can it not? I mean, that's very common with the people that we speak to, that, you know, they talk to us about how their doctor has told them they need a certain medicine or procedures done, but they're putting it off because they just can't afford it. Not being able to afford dental care is really, really common. It's also the case that we know that if you're in financial stress, that affects everything in your life, including your mental and physical health and your relationship. So it's not just, you know, I can't afford to pay the bills. It's just, you know, that's deeply stressful and harmful to an individual, that kind of financial stress.
Yeah, I think a lot of people listening, maybe who are comfortable where this is not affecting them, just hasn't really thought about all the tentacles that flow on from this. I just want to come back to 2022, because I would imagine that you're seeing a calibre of person that you haven't seen in the past. You know, people that do have good jobs. They're the sort of person that before we had this crazy situation with the Reserve Bank and the economy getting out of control that you probably didn't see.
No, that's right. I mean, when I first became a financial counsellor, so, you know, about 10 years ago now, I was really struck by how everybody that I spoke to had a story of misfortune or, you know, bad luck, and how it would be so easy for that to happen to anybody. There was always, you know, a story around how you could see that this thing had gone wrong in their life. So they might have become unwell, or, you know, their marriage may have broken down, or they became unemployed unexpectedly. And then, you know, they were struggling to get back on their feet. And that meant that they'd fallen into financial hardship. But now we're still talking to those people because, of course, you know, everyone, bad luck and life events, you know, it's something we all, you know, may have to deal with. We're still talking to those people, but we're also talking to people who have had no change in their circumstances. So they're often two-income households. They've been in the same job for a long time. Their income has remained relatively steady, but everything else has gone up. And that's meant that they're just not able to afford everything they need to pay. And the other thing with the people that we're talking to who are calling, you know, most commonly calling about mortgage arrears, is that we're finding that, you know, these calls are really complex because people often have tried everything they can to avoid falling behind in their mortgage, because they think, you know, the most important thing is that I keep paying my mortgage. I need to keep my home. So, you know, they've used up all their savings. You know, they may have used buy now, pay later more and more. So often, you know, people are talking to us about using buy now, pay later to pay for groceries, which is something, again, that we hadn't seen so much previously. Their credit cards are maxed out. As you said, you know, they're taking on more debt to try and sort of keep everything afloat. They're really complex calls, and it's different to what it was before the interest rates started to go up and before the cost of living crisis that we're in.
Yeah, that whole sort of stable job factor where you've got a couple of people that are making decent money, but they just cannot afford to keep on top of the mortgage. Of course, you would highlight to many of these people, in some cases they don't realise that they can ask their lender for more than a short-term payment. We've said this time and time again on the podcast. Make sure that you're talking to your lender. Your lender does not want to see you go into a mortgage sale. That is the last thing that your bank wants to do. But some people, Claire, are actually very nervous, aren't they, about talking to their bank? So they kind of just leave it when they should be talking to them.
Yes, that's true. That's very true. And we see that a lot. I think, people that we speak to are often, they may have spoken to their bank and they're really grateful that the bank has given them, say 3-month reprieve on paying or reduce their payments for 3 months. But people don't realise that the credit legislation that we have in Australia gives people the right to ask for their contract to be varied if their circumstances have changed. And it's worded so that the customer can ask their lender for whatever variation they need on their contract so that they can meet their obligations. And the lender has to consider that request. If they don't agree with it, they have to say why. Because this is a right that people have, if they can't reach agreement with their lender, they can make a complaint with the Australian Financial Complaints Authority. So people have more rights and more options than they often know about when they call us.
Well, you are doing some fantastic work there, Claire, you and your team. Keep going, obviously, because people do need that support. They do need somewhere to turn to. And thank you so much this morning coming on to the Real Estate Breakfast and just sort of highlighting some of those real core issue problems that are very real to people with these mortgages under struggling times.
You're very welcome. Thanks so much for having me.
Navigate the world of real estate like a pro with expert insights, opinions and trends to up your game and knowledge when buying your next property.
And our data showed that the younger you are, the higher your expectations are. So Gen Z feel like you need at least $177,000 to be on a good salary, whereas the kind of baby boomers at the other end of the scale, they're closer to $126,000. So they see a much lower amount as being the necessity that they need for a good salary.
The most sensitive markets to cash rate changes tend to be in Sydney and Melbourne, and they tend to be pricier parts of those cities as well, potentially because people have to go into more debt to buy into expensive markets.
Absolutely, and I think there's a proper war for talent in our industry. We need more good quality people joining the real estate industry at every level. Our industry is often misunderstood around the roles and responsibilities of what we do day to day, and we don't do a great job of educating people on how to get started and what they need to think about. You do need to think about the size and the scale of the organisation that you're joining and whether they have those systems to allow you time to learn.
They're moving to places like Bunbury, Albany, Busselton, Kalgoorlie. Obviously, they're going there because they've got work, and that's a big positive where historically a lot of these towns were a bit quieter. Most of these towns have 0, 1 or 2 builders in them. And so when you have a small increase in population growth and therefore demand for housing, the cost to construct those homes is far and above the median house price in those suburbs in the first place for the established homes.
Unlock the secrets of real estate and stay informed about the latest real estate buzz with hot market trends, emerging suburbs and hidden gems. We connect you to the best real estate information across Australia. The Real Estate Podcast.